Hi, Tom Lydon with ETF Trends here in Hollywood, Florida at the Inside ETF conference. And I'm here with Luke Oliver, Arne Noack with Deutsche Asset Management. Gentlemen, there's a lot to think about. Obviously at this conference, advisors are getting a lot of good nuggets. Let's talk about fixed income. What are you talking to your institutional or your advisor clients about? What do they need to be thinking about in the fixed income space for 2018?
Oh, I'm glad you asked, Tom, and thank you for having us. What is predominant in our conversation these days is specifically the area of US dollar denominated high yield bonds. And why is that? It's for the vast majority of time that ETFs have been around, high yield bonds have focused on the broad market. And what we have done beginning of this year is actually take a great effort to dissect that market further to give advisors a better way of managing risk in that space.
So high yield many times might be considered somewhat risky, although you're getting that better yield, but there are also periods of time, Luke, where rising rate environments haven't had a negative effect on the high yield market, right?
And for these reasons, that's why we've expanded our high yield offering. So at the end of 2016, we brought out HYLB, which was our broad beta play on high yield. And to Arne's point, this year we've brought out new products that allow you to dial down the duration with our short duration high yield, and we've also enabled investors to dial up the risk and dial down the risk with our high yield, high beta and high yield, low beta offerings.
So a couple basics, and most advisors understand, treasuries are most susceptible during periods of rising rates. Duration also has a negative effect, and with that lower duration, you're able to control the risk to some degree, correct?
That's right.
Okay, so if you're sitting down with an advisor right now, and they're looking to enhance yield and diversify, what would you tell them?
I would say, look at bonds as sort of the combination of two sources of risk. Interest rate risk, pretty simple. If your interest rates go up, your bond prices go down, not good for your portfolio. If it's the other way around, good. And then credit risk. Credit risk expressed by way of credit spreads. If they tighten, that tends to be good for your portfolio. If they widen, not so good for your portfolio. So two sources of risk that you now have the ability to look at and see how do they influence your portfolio and sort of how can you build on that. So what I would say is, do you have a view? Can we work on a view with regards to interest rate? Do you think interest rates will go up in the future? Will they go up gradually? Then, if so, maybe shorten your duration a little bit. Look at the shorter end of the maturity spectrum to reduce risk. At the same time, are you concerned with default risk rising? If so, maybe take off risk the table a little bit and go into what we have on offer, HYDW, which is a lower credit risk, high yield portfolio. If on the other hand you're actually quite constructive on the high yield market, you can afford to take a higher beta risk, a higher yield, then with HYUP, high yield up, you can actually receive a significantly higher yield than the average market in your portfolio.
Great information. You guys do a ton of research. You offer up a lot of videos. Also, you're excellent partners on the Smart Beta channel on ETF Trends. So if you want to learn more, you can go to the Smart Beta channel on ETF Trends. All these resources are available. In addition, go to your website, which is?
Xtrackers.com.
Xtrackers.com. So, gentlemen, thank you very much. Enjoy the rest of your time here.
Thank you.
Thank you.